Long-term mortgage rates don't actually move with the Fed rate. They move on Fed speak. And there was enough said at the July Fed meeting to see the biggest bond rally that we've seen since December 2023. And while this does not imply that rates will keep dropping in a straight line, it does reinforce the current trend. I mean, I have conversations on the daily about what will happen in September. How much will the Fed cut rates? And will they keep cutting? My answer is yes and. Meaning, yes, the Fed will cut rates, and the market has already come to that same conclusion. So if you're sitting waiting for September for the rates to drop, it's already happened. Let's break down Fed Chair Powell's specific word choice that dropped the 10-year Treasury below 4% for the first time since February and sent rates on an aggressive downward spiral without even moving the Fed rate. Then, how our current economic and real estate market is moving to give buyers a short window before the election and before rates drop further. Because while some headlines will claim the bubble is still expanding, I'm seeing opportunity knocking. But before I get ahead of myself, do me a favor and share this. Understanding these dips, locking in opportunities, and not getting lulled into thinking it's all down from here is what helps you gain confidence in making decisions in uncertain markets such as this. And while you're on my channel, make sure to subscribe to keep getting market and home buying strategies that empower wealth. Fed Chair Powell kicked off his conference on July 31st with written remarks, which are always redlined from the prior meeting. Small tweaks in the specific word choice are dissected and tend to move markets, even with the slightest wordsmithing. This month, Powell shifted ever so slightly dovish. During his 8-minute statement summarizing the economic landscape and the Fed's decision to hold steady, he noted that job gains have currently moderated, versus at the June's Fed meeting, he had stated that they were remaining strong. Unemployment has moved up but remains low, versus last month, they simply were remaining low. Inflation is now somewhat elevated, versus last month, they were elevated. And then there has been some further progress towards the Fed's 2% inflation target. In June, we only had seen modest progress. I mean, each of these delicate word changes, super minor, signified the Fed is getting closer to triggering a Fed rate cut. After reading the prepared speech, Powell then moved into his press conference, where a reporter asked him directly if the Fed would be cutting the rate in September. Powell did not confirm that they would. So it wasn't a yes, but it also wasn't a no. He replied, there is a scenario in which it does happen, and it requires 2 more months of data that tracks. The next morning, as we know now, more data that tracks did in fact come out, and the rally continued. Continued economic softening was evident as each report was released, hinting the United States is tipping into a recession, if not already in one, giving the equity markets fear that Powell, with the decision to wait until September, has waited too long. ADP employment reported 122,000 jobs created versus the 150,000 jobs the market expected. The cost of labor month-over-month change fell to 0.9% from 1.2% just the previous month. Initial jobless claims, i.e. people going on unemployment, jumped to 249,000. That's the highest in a year. And ISM manufacturing slowed to an 8-month low amid a slump of new orders. Then July's non-farm payroll and unemployment did the deed, secured the trend. Non-farm payroll for July, released August 2nd, tanked, showing only 114,000 new jobs were created versus the 175,000 jobs which were forecasted. and the 179,000 previous. Average hourly wages rose just 3.6% from July 2023. That's the smallest year-over-year gain since May of 2021. And the unemployment rate jumped to 4.3% versus the 4.1% that was both forecasted and previous. The so-called Sahm rule, named for former Fed economist who came up with it, Claudia Sahm, holds that a recession is almost always already underway if the unemployment rate based on a 3-month moving average rises by half a percentage point from its low of the past year. The jump to 4.3 crossed that threshold. This incredible 3-day trend will require a diet of rate-friendly economic data to be sustained. And note that it can also be reversed on a single report's release. Ultimately, the Fed does not move long-term mortgage rates, but word choice and economic data does. Meanwhile, the Denver real estate market has been taking a little snooze, as often happens in July with vacation and holidays. New sellers fell off 12% from last month. Active listings, however, are hanging on with 10,584 active listings as of July 31st. That's up 3.6% from last month and 68% from last year. Given the increase in inventory, days in the MLS are up 7% on average and 15% for the median, with close to list hitting its lowest percentage since July 2020 at 99%. Mortgage purchase applications also struggled at their lowest since 1995, dropping every single week, week over week, during the month of July. Well, that's depressing, but is it all about to change? I will not claim that the end of July and the first 2 days of August are the beginning of lower rates forever. But I do claim strongly that this move in the market comes at a time when buyers have an uncanny advantage. I say it all the time that you can't catch a ball when it hits the ground, only on its way down or the way back up. When this ball starts heading back up and the real estate market feels safe again, the majority of people who follow the crowd will jump back into the market. We are seeing a hint of this as August begins, and it would be no surprise to me if mortgage purchase applications jump next week. In the meantime, buyers need to know the score. There are 10,584 homes for sale, a number we have not seen since 2013. Home prices are flat, plus or minus 1%. Not dropping with a bubble bursting. And with listings sitting longer, a softer close to list gives buyers an advantage. And just for fun, let's add 10 rewards for buying right now in this market. All right? Seller paid closing costs, seller paid rate buy down, seller paid repairs, and seller paid improvements, price negotiation opportunities. No need for a buyer to waive inspection. And then there's inspection negotiation opportunities and time to think and strategize. Getting offers contingent on sale of your current home accepted, and when needed, longer contract to close options. The con in this market? Higher interest rates, but not for much longer. Well, that's a wrap. This is Nicole Ruth with the Ruth Team, powered by Movement Mortgage and proud sponsor of the DMAR Market Trends Report with your August update. I'll see you next time.